All right, let's jump right in. Today, we're going to talk about a really common mistake people make when they plan for retirement. It's this subtle little trap that feels completely logical, but it can quietly eat away at your financial security over the years. So let's break down what it is and, more importantly, how you can avoid it. Okay, first things first, we've got to put up the disclaimer from this source material. What we're talking about today is a thought exercise, okay? It is not investment advice. For your own situation, you should always talk to a qualified financial pro. Right, with that out of the way, let's get to the good stuff.
The source material really cuts to the chase with this one line. So, what is this huge mistake that almost everyone seems to be making?
You see, it all comes down to a simple comparison. It's a piece of math that feels so right, but misses the most important part of the entire equation. We tend to get hyper-focused on an investment's yield, and we think that's the whole story.
I bet you've heard this before. Or hey, maybe you've even thought it yourself. It just makes perfect sense, doesn't it? My income is 5%. Inflation is 3%. I'm making more than my costs are going up. I'm safe. It feels like simple winning math.
And here is the big twist. That simple, logical, and comfortable math, it's a trap. It's based on a complete misunderstanding of how these two forces, your income and inflation, really battle it out over the long haul. You gotta remember, retirement isn't a one-year sprint, it's a 30-year marathon.
To really make this idea stick, let's use a great analogy from the source. I want you to picture two cars cruising down the highway.
So, in this analogy, car number one, that's you. That's your retirement income. Think of it as your paycheck. And car number two, driving right there in the lane next to you, that represents the rising cost of pretty much everything. That's inflation.
Now, that yield you were so focused on a minute ago, that 4 or 5%, think of that as just your starting speed. It's how fast you're going on day one of retirement. It sets your initial lifestyle, sure, but it's only the very beginning of the race.
This right here is the real game changer. What truly matters is your acceleration. The rate at which your income grows year after year, that's your car's ability to speed up. And that single variable is what's going to decide whether you pull ahead and get richer or fall behind and get poorer for the rest of your life.
It's really just simple physics at this point. If the inflation car accelerates faster than your income car, it's going to pull away from you, and you're effectively getting poorer. But if your income car can accelerate just a little bit faster, you start to pull ahead. And here's the most critical part. That gap between the cars, whether it's good or bad, it just gets wider and wider every single year. All right, enough with the highway analogy. Let's put some real hard numbers to this. We're going to start with a scenario that, honestly, most people would look at and think is perfectly fine, totally safe. Okay, so picture this. You retire with a cool $1,000,000. It's generating $40,000 in income for you, which is a 4% yield. Inflation is just a mild 3%. But, and this is the killer detail, your income only grows by 2% each year. Your car's acceleration is slower than inflation's. Now just watch how this plays out. Year one, everything's perfect. You're dead even. But then in year two, something sneaky happens. Your income went up to almost 41 grand, which feels pretty good, but your costs went up even more to over 41 grand. You're already $400 behind. Now fast forward just to year five, and that shortfall is more than $2,000. Your paycheck is getting bigger, but you are absolutely getting poorer. And this bar chart just says it all, doesn't it? That red bar, the cost of living, is just pulling away from your blue income bar. That growing gap you see, that's your standard of living being silently eroded year after year after year. So, how in the world do you win this race? Let's check out a different set of numbers. And you'll see how a scenario that looks kind of scary on the surface can actually lead to a much, much better result. We'll stick with the same $1,000,000 portfolio, same $40,000 starting income. But get this. This time, inflation is a much higher, much scarier 6%. That sounds awful, right? Well, here's the secret weapon. Your income is growing at 7% per year. Your car is accelerating just one tiny percentage point faster than inflation. Now let's look at the results. It's like magic. In year two, your costs jump up, sure, to over $42,000. But your income grew even faster, to nearly $43,000. You now have a $400 surplus of real spending money. By year five, you're more than $2,500 ahead. You're not just surviving, you're actually thriving. And this chart is the complete opposite of what we saw before, right? Now, your income bar is the one pulling away from the cost of living. Even though your starting yield of 4% was lower than the 6% inflation rate, you still won the race. Why? Because your growth rate was higher. Your acceleration beat inflation's acceleration. That's all that mattered. And so this brings us to the real secret, the big takeaway, the new way to think about your retirement income. It's all about shifting your focus away from a static number and onto a dynamic rate of change, onto growth.
I'm going to read this next part directly from the source material because it's just that important. Your initial dividend yield does not matter nearly as much as most people think. What matters is the rate at which your dividends increase over time. So we have to stop asking the wrong short-term question, which is my yield higher than inflation today? And we need to start asking the right long-term question. Will my income grow faster than inflation over the next 30 years? That question, right there, is what truly determines your success. And that's really the final thought here. The goal of retirement planning shouldn't just be to survive and scrape by, it should be to out-accelerate inflation. Because when you focus on income growth, you can build a future where you don't just keep up, you actually increase your real purchasing power, and you get just a little bit richer every single year.